Hello and welcome to WealthWise. Those who understand market history are bound to profit from it. We are live on YouTube and X Spaces, hopefully. The S&P 500 has now posted 6 new all-time highs so far this September. And when bearish seasonality does not transpire, it is an indication that more powerful forces are at play. New all-time highs in September have historically been bullish. There's only 2 Q4 losses in 22 years, up 90% of the time. But we are prone to weakness and headline-induced volatility, especially in the week after triple witching for quarterly options expiration here in December. That week for the S&P 500, which we're in right now, is down 27 of 35 weeks after September quarterly options expiration, which was last Friday. This historical weakness, the week after triple witching, the end of September, Q3 seasonal weakness, and upcoming potential October phobia lines up well this year with the sell Rosh Hashanah Ba Yom Kippur old saw. But any pullback or retreat, I expect to be relatively brief and shallow. Afterwards, the current bull market is likely to propel the market to more new all-time highs as year-end approaches. I'm looking for a monster Q4 rally, getting us to S&P 7100 towards year-end. For my latest picks and analysis, go to stocktradersalmanac.com and check my Almanac Trader feed for more. Today, the venerable Bob Elliott joins me. Bob is the co-founder and CEO and CIO of Unlimited Funds, where he gives all investors access to alternate investments, access to strategies that are well constructed, as those of the largest, most sophisticated investors in the world. Before this, he was on the investment committee and head of Ray Dalio's research team at Bridgewater Associates, and also head of venture capital at Circle Up. So, Bob, thank you for joining me on the show today. What's going on? It was great to see you out of Future Proof.
Yeah.
I enjoyed your panel there on the alts, and we had a little social there with all the ETF people. You started with Ray Dalio. How did you get in with Ray way back?
Many years ago, Bridgewater was focused on hiring people from non-traditional backgrounds, because the reality is that you don't learn much in school that's of much value to being an investor, but you do learn how to think, particularly in the sciences. And so my background was in as a botanist, actually, a pure scientist,
Botanist.
with a ongoing interest in the markets, and you put that together, and they thought they'd take a chance on me, and look at this now. A couple decades later, I'm still doing it.
You learned how to forage for stocks and
For stuff
with Ray, huh?
Yeah, well, it's a hedge fund. It calls on my botanical background for sure. No, it's I think in a lot of ways, macro, the sciences are really a good connection to macro, because in a lot of ways, macro is like understanding a big system, lots of different cross-cutting forces and things like that. It's not, from my perspective and what I studied in botany, it's not that much different in terms of a way of thinking. And so I think that, and then relying heavily on, intuition and then empirics to assess those intuitions is, really critical part of developing good investment strategy. And so that's, that was the core of the skill set that I brought to the table, just then applied to markets and investing.
So, I mean, everyone knows about Ray. What was he really like to work for?
Well, I think in his my early years at Bridgewater, there's very few I've ever seen that were as rigorous and diligent in terms of thinking about macroeconomic dynamics, and also structured, I should say, which is important, because there's so much in macro that's very feeling and discretionary and stuff like that. And his sort of real innovation in the space was bringing rigorous systemization, which had mostly been like equity long, short, single stock type approaches to the world of macro. And so it was a very fertile learning ground to see that firsthand in terms of the process that he went through, the way that he thought about it, and quickly, when I started in the mid 2000s, it was kind of a boring time in markets, but became quite relatively quickly quite interesting when we got approached the financial crisis and then went through it. So it was also a very good time to get into markets, getting my feet under me, and then having one of the probably the most exciting market environment in the last 25 years.
You mean the
Pretty early.
GFC?
Yeah. The GFC was.
So you didn't know anything about the markets before you started working for Ray?
I mean, no more. No, it's a short story. Nothing that would pass muster with anyone.
Other than, random knowledge of looking at the Journal or the Times or something.
Yeah, exactly. Yeah.
So, what were some of the, I mean, you cut your teeth in the markets in 07, 08, and you must have learned a lot from Ray at that point. I mean, it was pretty hairy. What were the big lessons, or what was the insight that you picked up from him and that experience?
Yeah, I think in that period, what you really saw the value of quantitative macro understanding. So like a lot of the people, and the reality is there's a lot of people who are trading today who didn't live through it, so don't really fully appreciate it. In that time, there were a lot of people looking at a lot of specific things. So you talk to the AAA CLO person, and they look at their narrow thing, and you talk to the RMBS, subprime RMBS person, they talk about their little thing, and the bank analyst. But there were very few people who were connecting the pieces together to then say, okay, what does this total map look like? Like, if losses happen, like we're seeing over in some of these initial securities, if that expands out in a reasonable way across, say, bank balance sheets or insurance companies, what does that imply for their equity capital, given they were 30 times levered at the time? And what is the risk associated with that? And then what is the macroeconomic effect of that? Like, that holistic way of thinking about the problem was basically very few people were doing. People were very focused on their little sphere. And so that was really the it was both an overwhelming approach, but also a highly empowering approach, which, I sort of joke. I was working with Ray and he turned to me and says, this housing thing, is it going to be a big deal or a small deal? Figure it out. And I came back and I was like, I think big. and then we went through all the numbers and all the sheets of paper and stuff like that. And he's like, yep, I think it's going to be big. And then he was like,
when did you guys have that chat?
In the I distinctly remember it was the week before Labor Day 2007.
Okay.
Is when we sort of really synthesized that it was going to be a big deal. And then all sorts of interesting conversations that happened subsequent to that with the companies, with regulators, with the Fed, with the White House, things like that, sort of stress testing our thinking and helping them navigate through what was a very challenging time, for sure.
So how does some of that relate to like where we're at now in the market, and also like there was a bunch of things that went wrong with predicting the market in the last several years with the what's the curve, the Sohn curve, the inverted yield curve, and the whole predicting of the recession stuff. Even though we did have technically a couple of down back-to-back quarters in 22. So I mean, how does your experience there with Ray and the GFC and at Bridgewater, help you navigate the mistakes that were recently just made with the over bearishness, the recessionary anticipations that never happened?
Yeah, I mean, I think part of what it helped crystallize that cycle and a couple of the cycles before it were really credit-driven cycles. And what we've seen post-COVID in many ways is, I mean, it's not a credit-driven cycle at all. There's no credit. Like
It's
borrowing by households and businesses.
Like helicopter Ben money cycle.
Right. So first it started as money, an important money influence, particularly right out of COVID. But then it became, actually, the way I describe this cycle is kind of an old time cycle. What I describe as an income driven cycle, which is more akin to what we saw in the 50s and the 60s, where at some level it's like kind of boring, which is like people earn more income, they spend more, which leads to more people getting hired and spending more money, and then which leads to more people getting hired and spending more money. And it's not like, some people talk about this as like a spiral. It's not a spiral. It's just, this is how it works, which is like if household income is growing at 6 or 8% nominal, and they'll spend it basically 6 or 8%, and then that is the nominal GDP growth in the economy. And that approach, seeing that it wasn't a credit cycle, And because it wasn't a credit cycle, it wasn't particularly influenced by interest rates rising, which is what I think a lot of people got totally wrong, is where, basically what drove me for many years to have a totally non-consensus view that the economy was actually going to be stronger for longer than the vast majority of people expected. Now, that's changing a little bit here because we do have slowing income growth from households because the labor growth is slowing, and so that, we're now getting longer into the tooth. But for a long time, everyone was thinking that it was going to be high rates driving recession, and I pretty strongly disagreed with that.
Yeah, I mean, I was with you. I mean, I thought we had a major bottom there in 22. I'm looking ahead till next year, and I think some of this stuff might come home to roost. I know we're getting a little bit of a correction here at the end of September, very sort of typical seasonal timing, even though the bearish season didn't work, as I mentioned in my opening remarks. But do you see any of this unraveling anytime soon? Or is this AI tech super boom just going to have a little pause and then we move on through potentially bear recession next year?
Yeah, I think we're at a point where expectations are pretty high in terms of what's in the priced into the market. In many ways, that is normally what happens in sort of a late cycle type environment, and we're seeing economic slowing. And we're particularly seeing economic slowing if you absent the AI related investment. And this year is kind of like the peak growth, positive growth impulse. Doesn't mean it's going to not keep growing, but we're getting the most growth impulse because we kind of went from not much to a lot of investment this year, and so it would have to grow even faster in subsequent years to have even more positive growth effect. And so that's probably going to fade. And we have this household income problem. That's the short story. We have an household income problem, which is labor growth is zero, wage growth is slowing, and that creates a challenge for maintaining household spending, which,
That's the
investment in
economy.
AI can help for a little bit, but ultimately the US economy is households spending money on stuff and services. Like, that is what drives it. And so that
What
creates risk as we head into, the beginning of next year.
what happened to the broadening of this rally? Everyone was jumping on the last couple of months.
Well, I think in a lot of ways, if you look at like the real economy and like real companies, real economy sectors and things like that, the economy is not great. It's not that strong, and so it kind of makes sense that it's the sort of the AI self-reinforcing cycle can be positive, and then there's a lot of expectation that the real economy will benefit from that, and we haven't seen a lot of effect of that. And so that is, if anything, the disappointment probably is more likely to be in sort of the real economy sectors than it is in the AI names, because expectations of AI growth is actually flowing on a forward-looking basis, even though they're continuing to grow relatively rapidly.
So you left Bridgewater so you could bring this type of macro global analysis and strategies to every investor. What was the impetus for you to go out on your own? Did something, was it Ray winding down the business, or you just wanted to go put this, in the ETF market?
Yeah, I mean, when I started, Bridgewater was the challenger, like was a challenger, like no one had heard of it. It had a few $1 billion. You become the incumbent, and you know things slow down a little bit. And I was like, I'm young, I got a lot of life left in me. I want to keep innovating, and so it had always been nagging at me that like the economic structure of hedge funds doesn't make a lot of sense. And it also doesn't make a lot of sense that the vast majority of investors have no access to hedge fund strategies when they're so good. There's a reason why institutional investors want these strategies, because they're beneficial on a portfolio level. And so those two things sort of long nagged at me, and gave me the thought: could I bring sort of diversified low cost indexing, which has changed stock and bond investing a lot, to the world of hedge funds? And the hedge fund industry is not particularly incentivized to do that work, because it would be undercutting their whole business. And the companies that are incentivized to do it, like Vanguard, have tried, and they don't have anyone who has done anything in the hedge fund space, so they have no skill set to do it. So you kind of have to be an experienced outsider to be able to pursue this and build it, which is, that's what we are,
So
experienced outsiders.
how did you turn these hedge fund strategies into ETFs? I mean, tell me about Unlimited and how it works, and we'll get into the strategies a bit.
Yeah, so what we do is we use return information that we see from these managers in close to real time, and we infer how they're positioned in real time using proprietary technology that basically has us understand their long and short positions across major liquid markets. It's different for macro than equity long short than managed futures, et cetera. And then we just take those positions and we put them into an ETF wrapper, which is great because it's not only efficient to run, but it means that these strategies are available for all investors.
So you're shadowing other hedge fund strategies?
Yeah, I mean, one of the things you learn over time being an individual manager in the hedge fund business is you get sort of slapped in the face of reality that there is no single manager outperformance persistence relative to the peer set. Meaning, some years you'll be above your peers, some years you'll be below, some years will be above, some years will be below. And when you think about that, that's actually
Sounds
really
like my fantasy football team.
exactly, right? Hedge fund managers, particularly if you get to like the institutional hedge fund managers, they generate plenty of alpha. So that's not really, it's not that there is no alpha for the manager set. It's just that there's no outperformance persistence of any manager relative to their peers. And if that's the case, actually, your best bet is not to try and manage the money yourself, because you'll inevitably go down that path, assuming that you have institutional quality alpha. You're much better off in terms of generating a consistent return to essentially take the wisdom of the crowd to index the alpha. Because if you index the alpha, you basically help reduce the single manager idiosyncrasy, and you sort of extract the insight value of what these managers are. So like what I like to say is the wisdom of the crowd is actually a lot more consistent of a return than is any one individual manager.
So what's currently in these you got four strategies: the multi-strategy return, the managed futures, the global macro, and the equity long short. Tell me about those, and what do where are you positioned in there? And I guess they trade freely on that anyone can get into them, right?
Yeah, that's exactly right. So HFND, which has been around for a few years, in a lot of ways you could kind of think about it as like a SPY for hedge funds type strategy. It's designed to match institutional investors' risk tolerance, and it combines all the major hedge fund strategies there. So it's run basically at bond risk, targeting a few hundred basis points above cash in terms of return, which it's matched hedge fund industry returns well over time, and has met those benchmarks, but may not be
He's looking to
as
beat cash by a few percent.
but that may not be as exciting as what people are looking for. And so this year, what we did is we launched some of the underlying sub strategies. So as you mentioned, managed futures, global macro, and equity long short. But we're doing so targeting equity index like risk. So about 15% annual volatility, the sort of thing you get with holding the S&P 500. That creates essentially about double the return target of the hedge fund industry, how it would normally be packaged, and essentially cuts the fees in half as well. And a lot of people are very interested in those strategies because they're a lot more cash efficient, and you can also tailor, your strategies, whether you're looking at, say, global macro, which I kind of like to call an all-weather alpha, versus managed futures, which is a bit of a defensive strategy, versus equity long short, which is a compelling equity alternative relative to other active equity managers in the ETF space.
So what are some of the holdings? Like, how are they positioned? How's global macro positioned right now?
Yeah, so holdings for global macro, for instance, are roughly 30 long and short positions in the largest liquid futures markets, so currency, commodity, fixed income, credit, and equity indices globally, along with a few other positions where there aren't futures available, like in tips. And the positioning right now is actually, I think, very interesting because these managers are navigating what is such a classic late cycle moment, which is you want to stay in the market until you see enough of a turn to start to de-risk. And so they have actually traded this market very well, increasing their equity exposure over the last couple of months, winning on gold, winning on short dollar positions, trading bonds well, both short and short after the tariff tantrum, and then long more recently. And so really sort of navigating this late cycle environment, hanging in there. I mean, look, late cycles are hard. I can even speak for myself. I see a late cycle environment. I see a growth slowdown. I see some of these challenges. The question is, when do you turn, right? So that may be true.
How do
A
you see
month.
that turn?
I mean, right, and I mean, right now, my own sort of proprietary, my own personal views are, stocks look expensive relative to the likely macroeconomic rally over the next, 9 to 12 months. But that doesn't mean that stocks can't keep going up. And so what you need in a strategy is someone, it's a strategy that can be agile enough to basically hang in there until the turn happens. And that's exactly what these macro managers have been able to do.
How do you spot that turn? You just wait for the macro managers to tell you, or I mean,
Well,
what are you looking for the turn?
I think it's a combination of technical elements. It's the macroeconomic reality. So like, how bad does the data have to get relative to expectations, earnings information, and frankly, just mechanical flows that are unrelated to all of that, that sort of all typically combine to create a turn in the markets. And what we see right now is when you look at managers that are looking at all of those different things, you don't necessarily have the combination of attributes that are creating the turn. It's why they're long stocks, and why our macro strategy has done very well in this environment, not just long equities, but also picking up strong returns in gold and in dollar positions, as well as sort of orthogonal things like live cattle trading, which no one really knows much about, but has been a good trade. Common people don't know
My
much about.
understanding is you got to get into live cattle ahead of when they start buying food for the school lunches.
Well, it's been more of a secular story, and the cutoff of U.S. Imports of Mexican beef as adds further fuel to this fire on top of the Brazil tariffs. So you probably didn't have me on to talk the live cattle market, but it's actually been one of the more compelling winners out there for a long time.
Interesting. There's an ETF that trades that too. So you just have the futures in your managed cattle futures
in global macro and managed futures. Yep.
So you use machine learning for this, process of picking the investments. Tell us how that works.
Yeah, I mean, I like to say we were using AI before it was cool. For those folks who have been systematic investors, it's like everyone 3 years ago or 2 years ago woke up and was like, "Wow, AI!" It's like the world has changed, and you're like, "Yeah, actually, this has been evolving for like 30 years."
Yeah.
So what we do is we basically use it's machine learning. But really what it is, it's just an inference technique. So what we do is we look at the returns, we compare those returns to a plausible set of exposures based upon the manager's style. Like, global macro managers trade portfolios that are different than equity long short. And we tailor it for each manager, and then we back out what positions must be driving the returns that we're seeing. And the way that we're able to do that is because managers don't actually shift their positions instantaneously. You can't go long stocks one day and short stocks the next if you're managing any reasonable amount of money, because you'll be eaten alive in transactions costs. And so what ends up happening is, positioning is sort of continuous over time, which means that it's path dependent, and it means there's a lot of information value in the path of returns, because there's not that many portfolios that essentially describe today's returns and yesterday's returns and the day before and the day before the day before that are all adjacent to each other. And so because of that, we can basically infer what are today's positions in the context of those previous portfolios. It's the stuff that computationally 5 or 10 years ago just was not commercially viable, but with the advent of much cheaper compute, we're able to calculate essentially millions of probabilistic portfolios at in real time every day to understand how these managers are positioned.
So the bull market, you think, is still in play? It's still in full force. You've got some concerns. We're looking at a little softness here. I mean, I'm not expecting anything more than a few percent here and there. What's your take on any pullback here and your outlook for the rest of the year for the market?
Well, certainly when you look at how managers are positioned, they continue to be um, quite favorable to the equity market, both um, long equity risk, but also particularly long tech stocks is the short story. Continue to be overweight the tech component and a bit underweight the rest of the market. Sort of reflecting that the liquidity party here is not yet fully over. And I think that in some cases makes I think there's justification for that. We are in an easing cycle. There's a lot of pressure to ease further. And so while economic conditions are slowing, the liquidity genesis that comes from the easing can easily be positively supportive to financial asset prices. And look, we've seen that, like, asset prices in general, are up 7 or 8%. Balanced asset prices are up 7 or 8% over the course of the last couple of months in response to this easing impulse, which has not fully flowed through completely into the financial markets. I think there's some life to that, but that will eventually end. And I think one of the challenges in a late cycle environment is there's almost always sort of optimism on the first cutting. It's like growth weakens, central banks cut. This is
Yeah.
not just the Fed. This happens all over the world. Central banks cut, and people are like, "Oh, we're in good shape. They're cutting," as if the problems that were driving the cuts have now
Fixed.
gone away.
Yeah.
But they're not fixed, right? The labor force growth, or not labor force growth, but job growth is zero. And it's going to be tough to maintain this sort of expansion in an environment of zero job growth. And so typically the way this works in typical cycles is it takes some time, 6-12 months, for that impulse of easing to sort of fade away and the macroeconomic reality that's driving that easing to sort of come to the fore and start to change expectations. It's like what I like to say is, everyone's excited about easing, but the conditions that will lead to all this easing are not necessarily the conditions you really want for stocks, maybe in the short term, but certainly not in the medium term.
So, I mean, you've observed that there's a significant amount of the markets have priced a significant amount of Federal Reserve easing in right now. What could derail that easing? What do you think might disappoint or might make the Fed stop easing? And then what happens to the market?
Yeah, I mean, if you just look over the course of the last almost 3 months now, basically the entirety of the equity market, the last 10% move up in the equity market can be attributed to falling discount rates. Depends on exactly how you do it. And falling discount rates are reflective of increased expectations of easing. And so there's a lot of people who look at the equity market, they're like, oh, it's booming because everyone thinks growth's booming. Like, no, actually what's going on is if you lower interest rates, it helps all asset prices. It helps gold, it helps bonds, it helps stocks, it helps everything. Everything goes up. The challenge is if those easing expectations are met, and what you look at right now is a lot of easing is priced in. Now there's certainly a strong push from the White House and others to
Yeah.
deliver on that easing, but we've kind of gotten to the point where it's hard to believe that there will be even more easing unless there is than is priced in, unless there is even more weakness. And if there's even more weakness, that's not a great outcome, right? You don't really
So
want to be
what's
holding.
priced in? 2 more quarter points or 3 more?
Yeah, I mean we've got uh what more than 100 basis points of cuts expected over the through into next year. So pretty aggressive set of cuts that are priced in. Um,
What does that do to inflation and the tariffs?
well, who cares about inflation? The Fed certainly doesn't.
They said it was getting to 2%. Ha!
Yeah, well, I mean, they always say inflation will be at 2% 2 years from now. It's like perpetual. It's like certain policymakers who always finish policy 2 weeks from now, or certain macroeconomic pundits who always call for a disaster 24 months from now. It's always a little bit out in the future, so you never quite get held accountable for what you're doing today. But um, what I'd say is that the expectation of those sorts of cuts are reflective of the fact that at least there's been indication of a shift in the Fed's reaction function. where their reaction function is that they don't give a shit about inflation. And when I say that, I mean, like, they do not care what is going on with inflation. Inflation could print at 3, it could print at 3.5. In any time frame that anyone cares about, they'll just say it's transitory, and who cares? Will it be
They just care
transitory?
about jobs right now.
They just care about jobs right now. And they made as much clear because, like, look, I know we're all worried about jobs, but the unemployment rate is, it's at like the 20th percentile if you look back over the last couple of decades. Like, I remember in 2000 when the unemployment rate was like not that far from this, and it was like the greatest economic boom, that anyone had experienced in their lifetimes, right? So like unemployment rate is not in bad shape,
Yeah.
and
So
yet,
where's the problem in employment?
well, because the problem in employment is that we have the curious low demand for employment, but also low supply, which is keeping the unemployment rate relatively stable, all things considered, but is negative for growth. That's a big thing. Like, growth is driven by the absolute magnitude of employment growth. It's not driven by the unemployment rate. And so you can have a negative growth or a weak growth environment with a stable unemployment rate in an environment of highly constrained labor supply. And that's kind of the mix that we have right now. And that's a pretty tough environment. But from the Fed's perspective, maximum employment is their goal. And there is no, employment's pretty good from a tightness perspective when
Yeah.
they look at the stats that they care about. I think the problem is, and obviously inflation is above, and based on their projections, will be above their target, which is 2% for 81 months, at least 81 months.
I think that's a fallacious target.
Well, I mean, it certainly, at some point, whether you agree with that target or not, if you keep saying that your target's 2% and you've failed to reach it for 81 straight months, like,
Yeah.
who cares? I could say I'm 6'6" all day long, but it doesn't make it the reality, like.
Yeah, I think that my look at the CPI going way back, it's 3.1% average. I don't know where they're getting 2% from. So are we in danger of a stagflation situation that's been bandied about for a while? I mean,
Well, I'm not sure stagflation is really the big issue here. I think because, look, stagflation is is
just a hot button word.
it's a cute way to describe what could happen, but let's be honest, like, it's stagflation. Like, my parents' stagflation was in the 70s, where you had growth that was contracting and inflation that was 20%.
I was there on odd and even days with getting gas.
Exactly.
I got a couple of years on you.
You do have a few years on me, that's for sure. I don't know if you had the full head of hair back then, but
I did. It was long and curly.
But if you talk to anyone who was around back then, and then you hear people say stagflation today, they're like, what are you talking about? Like, that is just such absolute nonsense. And so, by the way, our attempts at this for the Twitter thing, people are complaining about our echo. So
yeah, I figured we got to do it a different way. I think maybe Todd's got to run it. Yeah, thank you for letting me know. I was worried about that. So, what's causing this job weakness? Is it everyone's concern about the confusion with the administration and the tariffs and all of the changing goalposts, or is there something else at play there?
Well, I think the big challenge here is the low labor demand is happening because of uncertainty. Like, basically, we have what I call a frozen labor environment, and that's tough because there's no real hiring, but there's no real firing. And so everyone's kind of frozen in place in an environment where they basically say, hey, look, I don't know what to do in this environment, right? That's basically the chapter. I don't know what to do in this environment. And if you don't know what to do in this environment, then you basically do nothing. And doing nothing, meaning zero job growth, is not great. It's just we're all kind of frozen in place. And so I think the question is what pushes us out of that environment? Is it going to be you either have to have a pickup in demand or you have to have increased confidence in terms of what the forward-looking picture looks like. And there's a little bit of an indication of a bounce in demand the post the tariff situation, but I think the question is really like, are businesses going to get confidence in terms of investing? Because when you hire somebody, you're investing for the future. Are they going to be able to get that confidence? And so far, they're not very confident, whether it's CapEx, whether it's hiring. There's just too much uncertainty right now, given
unless it's the AI space or the data centers. That seems to be the only place where there's any hiring.
Exactly right. There's a lot of confidence that you at least have to claim to have a story on AI.
Right.
Certainly the confidence in that. Whether AI is actually beneficial, that's a whole different story. And so people are investing in that. But other than that, like, everyone's kind of in wait and see mode.
So what is the future of alternative investments? Is it unlimited? What trends do you see, in the alt investment space, and how are you positioning yourself to capitalize on these?
Yeah, well, I think the biggest story in the alt space right now is there's very little um, justification for a lot of folks who are providing alts, particularly in sort of the illiquid space, for the fees that they're charging. Now, that doesn't alts themselves, whether it's alternative asset classes like VC or private equity, or alternative strategies like what you see in a hedge fund portfolio, there's good reason to include those in your asset allocation. The challenge is that the fees are too high. And so I think what we're, and I sort of joke sometimes, I talk to people like the 2 and 20 fee structure and how a lot of these strategies are run. Like, it looks today the same as it did when I started in the industry 25 years ago, and also like 25 years before that. Like, nothing's changed. Like, what industries in the world look the same today as they did 50 years ago? Like, only the 2 and 20 business model, right? I always like to say this to prospective venture capital investors, where I mock them for basically looking like they're doing the same thing that they were doing as people did 50 years ago, like staring into my eyes and hoping to God they could figure out whether I'm smart or not and will succeed. And 90% of the venture capitalists get offended and leave, and a small number are like, yeah, I guess that's true. Self-aware enough to recognize that what I'm saying is true about them. An even smaller number then invest. But I think we're moving to a world where basically, this democratization of alts so far has been find more people to hold your bags, and people are going to get sick and tired of it, because you can't have more people holding your bags. And so what it's got to be is it's got to be lower fee, it's got to be liquid, and it's got to be compelling for investors at those fee points. And I think that's where we're going. Now, does it take 5 years to sort of get there, or 10 or 50? Vanguard started in 1975, and it took certainly 25 plus years before it was universally accepted as a sort of public good in the markets. But hey, I got a lot of career left, so I can keep going at it for 25 years, no problem.
Who else is doing this other than you?
I mean, there's a few folks who, in the hedge fund replication space that have been around for a while. So like Andrew Beer from DBI, or Corey Hoffstein over at New Fund Research has also been doing this. So the replicators have been around for a while, but they're usually quite concentrated. They're like specifically do managed futures or whatever. There's not a lot of low cost, liquid 2 and 20, product issuers out there. And the reason why that is like, why would you do that if you could charge 2 and 20? Like, why on earth would you give people liquidity and charge lower fees if you can lock people's money up and charge high fees? Like, it's, in the same way they said to Bogle, like, why the hell would you charge, 10 basis points to run a mutual fund when you could charge 85 basis points to run a mutual fund? it's and I have to say, certainly some days I ask myself that same question.
Yeah, but the world's really going low fee, especially the
The world's
RIA
going low.
space.
Yes.
I mean, if you don't have a low fee, there's, I mean, even just looking at the difference between all the crypto ETFs that came out, all the lower fee ones are working. So listen, I want you to get back to me. I want to get back to you when you see this turn, when the hedge fund indicators, start to see that turn, because I think we got a few months left, maybe 6. I'm looking for some weakness next year, middle of the year, Q2, Q3. But great conversation. Appreciate you coming out. Thanks everyone for tuning in.